Hello everyone, it's Dwayne Malone with ECAM. Welcome to the ECAM market update as of the 17th of August 2011. I want to start this update by going over a few of the charts that I discussed in my last blog entitled Wait. We're looking first of all at the S&P 500 index on a monthly chart. As we can see, as of the month of August, we're down 7.7%. However, we're well off our lows, and we're currently sitting at 1192.76 as of Tuesday's close. If you want to have a look at the charts, we can see that we've got the 12-month simple moving average, which I've said before is one of my indicators, which if we close the month below, that would be an indication we've entered a bear market, along with any of the corresponding indicators showing the same. As we can see, as of today, we are inter-month below the 12-month simple moving average. Some of the technical indicators have yet to cross. The RSI is still sitting at 49.21, so just below the 50 line. I've also drawn some blue dotted lines, which was the correction back in May of 2010, and that's further indication that if we were to break below these lines, that would be more of an indication we're into a real bear market situation, as opposed to a head fake like we had back in the May 2010 period. So I've done that with the RSI. In addition, I've done the same with the full stochastic. As you can see, we got down here to about 55. We're still sitting well above that, so still no danger that we've indicated a bear market on the stochastic. You can see with the MACD, during the decline we had in May 2010, we never did cross below the red line here. Now we are circling over, and it appears we're going to try to cross. However, we've yet to do so. So once again, this remains bullish on the MACD. Some of the more volume-related indicators are indicating that we have entered a bear market, such as the ADX, which has turned bearish with the DI minus line crossing above the DI plus line. We've also got the force index, which is indicating a slight negative pressure, and the stochastic RSI has crossed below the 0.5 line, which is the demarcation line for a bull or bear market based upon this indicator. Once again, you can see that of all the indicators, the only one that's actually confirmed that we perhaps are entering a bear market at this stage on the monthly chart is the stochastic RSI. As you can see here, this was the low set in May 2010, and we have broken below that as of I guess what would be about July of 2011. So once again, until the end of the month, this chart is not valid, so we can consider it neutral. However, it is leaning bearish, and we need to see some confirmation from the end of the month in association with our daily and weekly charts to confirm that in fact we have entered a bear market, but at this point it is looking rather bearish on the monthly chart. The next chart is a weekly chart of the S&P 500 index. Just a couple of points to point out. Once again, this is the second of my two indicating charts I use to indicate whether we're in a bear or bull market. This chart did turn bearish back in, I guess that would have been late May, early June, when price crossed below the Bollinger Band midpoint, which is the dotted line here, along with corresponding indicators also turning bearish. As you can see, the RSI popped down, came back up, but it's now back down again. As well, you can see that the stochastic did cross below the 50 line. MACD has been bearish all the way through, so since basically back in March, it has been in decline, which is indicating the momentum of the market is declining. As well, of course, once again, the ADX line is in decline, with the DI minus line well above the DI plus line. Force indicates, of course, is indicating as well that there is a certain amount of selling pressure currently in the market. So from an intermediate point of view, the weekly indicators look bearish. As I pointed out once before, we were in this consolidation range, which I've drawn as a black box. Many times in technical analysis, you will find that once price gravitates out of an area of consolidation, it'll move into a corresponding area of consolidation very similar in character to the previous. So I've tentatively drawn this box here as our trading range that we're in for basically all of 2011 year to date until we broke down. And at that point, I've just basically taken a copy of this and transposed it into this next area. So as you can see, we've entered this area, and it would be very typical, in fact, to see price remain within this box until at some point either it breaks back above or below. If we're to go below, of course, that would be a very bearish indication. Back above would indicate that we're into a consolidation range, which we have successfully tested, and if we broke back above, that would be bullish. But as of right now, the weekly indicators are indicating once again that it is a bearish situation in the markets. As far as price levels to be looking at, should we continue down, I want to point out that I've drawn a Fibonacci retracement numbers on the chart from the 666 bottom in 2009 up to our tentative high at 1370 back in May. And as you can see, the numbers here, the 38.2% retracement was at 1101.73. And in fact, we almost hit it right to the penny. It was 1101.54 we hit on our latest downswing, which is very interesting. You'll find very often Fibonacci numbers tend to hold declines or advances. So if we were to actually break below 1101.73 and put in a new low, the next low to be looking at is for a low at the 50% retracement level, which is 1018. And as you can see, that actually corresponds quite well to some other areas of very important support over the last couple of years. You can see here, we broke above it in April 2000 or August 2009, tested it several times in the fall of 2009, and then once again we tested it once again in June and July of 2010. So as well as being a nice, just visually a very nice level of support, it's also backed up by this 50% retracement level. So if we were to break below current levels and we do continue back down, the next level I'll be looking at is 1018 or thereabouts for the market to settle out on a bottom. The next chart I want to talk about is the daily chart of the S&P 500 index. As you can see, we had this level here that I spoke about last week, where there was a tremendous fight between the bulls and the bears, essentially between the levels of 1119 and 1173. This was unprecedented. We've never had 4% plus daily moves up and down in the S&P 500 index ever in the history of the index. Also, the same thing was reflected on the Dow Jones Industrial Average. Never in 112 years had we seen such violent up and down midweek changes. So this battle, if you consider this like a battlefield, was actually won by the bulls at this point. The bears were unable to push it down below 1119 on a closing basis, and the bulls have now been able to push it above 1173 on a closing basis. So once again, these are daily charts. So intraday, as you can see, there's a bit of a tail on this one. So intraday, we were able to break below, but by the end of the day, we stayed above 1173. So that is now my line in the sand. On a very short-term basis, I am bullish. Unless we close on a daily basis below 1173. Should we do so, then I would get back to being very neutral at that point. And should we close below 1119 on a daily closing basis, I would turn very bearish, and that would be a good shorting opportunity. Just for disclosure's sake, I am still maintaining my 50% position in my Provident Fund due to the nature of the weekly and the monthly charts. However, in my trading account, I went long as of 1173 with a fairly substantial position. However, I am able to basically put in a stop loss on that trade just below 1173, so that if for some reason this market turns back around and heads south on me, I'll be stopped out for basically a very, very small loss. So as I said before, it's times like this when the markets are in your favor as far as trading is concerned, because you can quite easily define what your risk profiles are and areas where you should be paying attention for perhaps moving out of a trade if you've gotten it wrong. As of right now, as I said, my trade is profitable, and I'll continue to monitor that. But once again, if I hit a closing basis below 1173, I would be certainly stopped out and back to a neutral position in the markets. On the last chart I want to look at today is the S&P index once again on a 60-minute chart. Once again, this is just zooming in from the monthly to the weekly to the daily to the very short-term 60-minute charts. I've drawn what appears to be a bearish wedge, as you can see, defined by this lower trend line, which has been tested 3 times now, and an upper trend line which has also been tested 3 times. So this is a valid signal, a valid wedge. Should price break below this wedge, then that would be corresponding to a drop below 1187. As you can see, that's held up pretty well in the last few days on the 60-minute chart. So below 1187, I would suggest we're going to be heading back down towards 1172, which, as I said, is my line in the sand from my previous chart. And if so, that'd be a good sell signal. And below 1117, once again, would be a good short signal. Momentum is coming down, as you can see by the histogram. We're now below 0. So the momentum on the initial push has actually come out of the market. We want to see this start pushing back up again if the bulls take control. Otherwise, if this continues to go down, then the bears will certainly have the day, and you can expect lower prices ahead. Once again, just to reiterate, very short term I am bullish, intermediate to long term I am bearish. This is a trading market. It's a market where you have to be very careful with your capital. For those that are in the Provident Fund, I suggest maintaining about a 50% position for the time being till this all sorts out. Below those 1117 levels, I will be moving to cash in my Provident Fund. As of right now, I'm going to maintain my current position at a 50-50 until I can see some indications that the intermediate term is switching back up, at which case I would want to increase my exposure. But as of right now, I think the 50-50 exposure, cash versus equities, is a good position to be in. Thanks for listening. This is Dwayne Malone with ECAM.